This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our webpage, stltest.net, where you'll find links to all the dummies books, the blog, the podcast, and links to all my YouTube videos. Interesting topic today, taken from this article that is from the Wall Street Journal about UPS, and this has to do with UPS and shipping e-commerce items. I've written a blog called Growth in a Low Margin Business. And there's a trend that's happening that is really upsetting the apple cart for UPS and their profit. We've got more business moving online with e-commerce, and that requires more shipping. And it so happens that UPS is one of the big shippers of these goods that are being bought and need to be sent through e-commerce. So somebody has to ship all this stuff we buy on the web. And so this is the article that was out of the Wall Street Journal, and I quote some interesting information from this article. Net income last year, 2013, was the highest ever at UPS, but their profit margins have been flat for 3 years. E-commerce sales generally, not just based on UPS shipments, but everywhere, are growing rapidly. In fact, in the second quarter of this year, 2014, 5.9% of all retail sales are from e-commerce. That's growing very rapidly if you look at recent history. Amazon, obviously one of the biggest, if not the largest, of the e-commerce companies, has introduced free shipping as a way to gain market share. So now people are even more apt to buy through e-commerce because they no longer have the barrier of having to pay for shipping. Now, because Amazon is such a large UPS customer, they can pressure UPS to lower shipping prices. So there's big time pressure on the top end on the sale price that UPS can charge to a big client like Amazon. The nature of e-commerce is that UPS has shifted from a company years ago, back in the day, that used to ship big, heavier items mostly to businesses, and now it's had to make more frequent stops to deliver smaller package to consumers who are buying through e-commerce. And the shift requires more time and fuel expense, which increases UPS costs. So now they have cost pressure on the bottom end, more costs. They have pricing pressure on the top end to keep their prices down. So the question is, well, what does a company like UPS do to lower costs? And they're doing two things specifically that are mentioned in the article. The first one was particularly interesting. They're going to introduce pricing that will encourage company customers to use boxes that fit the items that are being shipped, so there's less wasted space in the box. That can give more room on the trucks if the boxes are better designed to handle what's inside of them. There's less wasted space in the box. You can fit more boxes on a truck. That saves the driver time from having to go back to a warehouse and load more boxes. You save fuel and time, and you lower your costs that way. That's one way. The other is route optimization. They're going to try to do a better job of planning the best way to deliver and pick up packages. I'm going to add and pick up there because it's about pickup as well as delivery. Now, if we translate this into an accounting issue, this is really a sales mix issue. And sales mix deals with the dollar amount of sales you generate from a particular group of products or mix of products. And as a manager, you need an apples to apples comparison of multiple products to see what's more profitable and what's less profitable. And since each product has a different sale price, I'm going to leave off profit margin. Management needs some sort of tool to compare profit levels. So if you're selling power equipment for $500 and you're selling wrenches for $1, you need some way to compare the profitability of those products in your hardware store, for example. So there's really two ways to make a comparison. The first is profit margin percentage. We have profit margin defined as net income divided by sales. So if your $100 item generates a $15 profit, your profit margin is 15 divided by 100, or 15%. So we're looking at things in percentage so we can do an apples to apples comparison. So if you want to increase total company profit, you attempt to sell more of the product that generates a higher profit margin percentage. The next one's a little more complex, which is contribution margin per unit. Contribution margin is defined as sales less variable costs. And another way to think about profit margin is it's the dollar amount you have left to cover fixed costs and generate a profit. So a second way to analyze sales mix is, why don't we look at contribution margin per unit? Particularly if you assume that all sales are going to incur fixed costs, so that putting a fixed cost component into your analysis of a particular product isn't really necessary, because everything you sell is incurring a fixed cost. So let's take fixed cost out of the analysis and only look at variable costs and sales revenue. So in this case, the product with the higher contribution margin per unit would be more profitable. And if you want to increase profit, you shift sales toward those more profitable products. So yes, one thing that UPS is doing is they're trying to attempt to lower costs in their e-commerce business, but another part of their strategy will likely be to increase sales in other non-e-commerce businesses that are more profitable. This takes us into another video that I've got out there on cost accounting. It happens to be Cost 21A, Sales Quantity and Sales Mix Variances. You'll also find this discussion in Chapter 13 of my book, Cost Accounting for Dummies. I can email this sheet to you if you want to email me at ken@stltest.net. It's on the website. This is a situation where we look at units sold and we take sales less variable costs, and we come up with a contribution margin for two products, one called Chicago and one called Stuttgart. So here are the contribution margins in dollars. And this happens to be our budget in blue. So we budgeted a sales mix of 40% Chicago and 60% Stuttgart. And we came up with a budgeted contribution margin per unit. So for example, for Chicago, we take 200 units in green. We consider the $45,000 contribution margin in blue. Blue divided by green gives us a contribution margin per unit of $225. And for Stuttgart, contribution margin per unit of $200. I won't do the whole analysis here, but we go down here and we look at actual results, and you'll see that the actual sales mix is a little different. And then at the bottom of the graph here, I talk about variances in sales mix. We have sales contribution variances, sales volume variances, and then finally at the bottom we have sales quantity variances and sales mix variances. Don't have time to go through all the numbers, but if you'd like that template, I can certainly email it to you. That's as far as we'll get right now. Remember that my email, along with everything else, is on the website, stltest.net. There's my email, ken@stltest.net. Or you can find all the Dummies books, 3 right now, soon to be 4, links to the blog and the podcast. This will be part of a podcast, and also my video links. Thanks very much for watching, and we'll see you next time.